A company purchased furniture on 1st April 2003 for rupees 5 lakh. It is to be depreciated at 20% per annum on diminishing value method. Now students, diminishing value method implies written down value method. In this case, depreciation should be charged on the book value that is appearing in the beginning of the year. Then accounts are closed on 31st March each year. So in this case, the financial year for the company runs from 1st April 2003 till 31st March 2004 or till 31st March next year. Then we are required to show furniture account, not machinery account. We are required to show furniture account till 31st March 2006. Now let us start making the entries. Since we have purchased furniture, the entry would be furniture to bank. So in account on 1st April 2003, it would be recorded as to bank account rupees 5 lakh. There is no other purchase. So at the end of this financial year, now the financial year ends on 31st March. And since it started in 2003, it would be 31st March 2004. Depreciation would be charged by depreciation account. It would be 20% of rupees 5 lakh. So for first year, depreciation would be rupees 1 lakh. On this date, we'll find out the balance, that is by balance carried down. 5 lakh minus 1 lakh comes to rupees 4 lakh, and the total is rupees 5 lakh on both the sides. Again, the closing balance for the year 2003-04 would be brought down as opening balance in the next financial year, which begins on 1st April 2004. Since it was ending on 31st March, the next year begins on 1st April 2004. It would be to balance carried down rupees 4 lakhs. Again, there is no purchase or sale. So at the end of this year, this financial year, that is 31st March 2005, depreciation would be charged by depreciation account. Now in this case, since it is diminishing value method, depreciation of 20% would be charged on the book value. It would not be charged on the cost, it would be charged on the book value in the beginning of the year, which in this year is rupees 4 lakh. So the depreciation would be 20% of 4 lakh, that comes to 80,000. Again, calculating the balance at the end of the year, 4 lakh minus 80,000 by balance carried down, it would be 3 lakh 20,000. Repeating the same thing, it would be brought down as opening balance on 1st April 2005, that is the amount of rupees 3 lakh 20,000 would be to balance brought down 3 lakh 20,000. At the end of this year, that is 31st March 2006. By this year we means this financial year. Depreciation would be charged, that is by depreciation account, 20% of 3 lakh 20,000. That comes to 64,000. Again students, 20% of book value would be charged because it is diminishing value method. So the balance carried down at the end of the year would be 3 lakh 20,000 minus 64,000. So it comes to 2 lakh 56,000. Totaling it out, total is 3 lakh 20,000 on both the sides, and this balance would be brought down as the opening balance in next year. And we leave it there because it was only till 31st March 2006 that we are required to prepare this furniture account.